Hello, entrepreneurs. Today we're going to do module 7. We have 2 sessions. So this is session 1 of 2. We're going to basically be looking at the concept, financial concept. How do they relate to our day-to-day as we are running our business, but also just trying to put all the pieces together from business economics, just also understanding accounting, and putting all of that together to how then that relate to finance. I hope you're going to enjoy it. Thank you so much for joining us today. I will start with the sharing of our session. To the slides. Okay. We have a lot of content to go through. I think for me, one of the reasons why I honestly wanted to cover this was because I kind of felt like once we have set the goals and we're clear what is the right business structure we're gonna use, it's then about understanding the economics and understanding how the world of finance really work so that we can make some money. But also I think it's about how then do we integrate that understanding to how we make decisions so that we can make decisions that are going to ensure that we make money, we actually keep the money, and we also raise the money. So I hope you're going to enjoy it. And please remember to leave us comments. I also have made sure that we will have a link of the other related videos, especially in the areas when it comes to finance. Put it below, but also I will put it on the top. Okay, financial concept when it comes to business. What we're going to cover is really about how you can transform your life, irrespective of the background. Even if you come from an environment where you're not a person who feels comfortable with finance, we're going to change that. I intend to change that. I also think we just need to somehow make sure that entrepreneurs and anyone who go through this program gets comfortable with numbers, doesn't get intimidated by finance. And I think most cases, sometimes the people that come from the finance background, they take this for granted that, oh, that's a norm, whereas it's not necessarily a norm to most people. I know certain clients just get freaked out by just seeing the numbers. So I think we're gonna need to overcome that, but beyond that, also be comfortable with how the numbers actually look like and how they actually work. So we will go into a deeper understanding of what does the world of finance really means? How does that relate to economic environment? How do corporate finance decisions then get made within that context? And what's the role of financial management activities? And what exactly is that? We'll also cover the role of accountancy and bookkeeping. And the last part, we will then cover the language that is being used on day-to-day in business and how you can actually see and interact. I've just mentioned 5, but on the book and also on your module, I have a whole list of others. You're gonna need to get used to the language of business so that you are comfortable also in discussing the matters that matters the most. So I think to really grab or understand in totality the financial concept, you've got to need to understand that we're operating on an environment where it's highly influenced by political, economical, social, and technological factors, environment factors, and also legal. I have done quite a more work on this when we did a strategy. So if you are not sure about how these relate, please have a look on the strategy session program. But all of these factors, they then influence how you think, they influence how you feel about things, but they somehow set up a clear destination for you to either you on that destination. And it's almost like what I'm saying is that the parameters of your growth are already set by the environment you're coming from. And that environment is influenced by PESTEL, which is political, economical, and social, and also technology, environment, and legal. So all of that then influence. So when I talk about social, I'm mainly looking at the culture, where you come from, what you stand up, how you were raised, how you interpreted those things. So it's almost like your financial map, it's already there. And what you gotta need to get into is to understand that as much as it's already there, it does not mean it can't be changed. So, and because all of that external effect then affects how you will respond to it internally, how you will internalize that information. So it then creates beliefs, it then creates certain emotions, and then it fosters certain thoughts, and then again, it keeps on going on until you break out of it. So you gotta need to understand that all your actions and decisions are not just influenced by the external, but you gotta need to put them internally for you then to be able to have a proper response. So this is the internal campus, and there's two more legs that are missing here, which is action. Obviously that is external, but it then influences on how you will behave and do things, your beliefs and action and your habits. So all of those things, they then contribute. So what you have to do to break out from this map of your financial status and your financial destination is to break out from your environment, is to think differently, is to behave differently than what you are actually saying. And by doing that, you will change your financial destination. It will not be set like what I was saying earlier, that it's already set up for you. And then if that's the case, then let me come back into saying, okay, I understand, you understand that all what you're doing is all interlinked, is interconnected. The external factors and your internal factors, how you process the information that you have received. But from that, then creating you to be able to either earn money, keep money, or raise money. But it also is what will contribute whether do you create wealth or do you create poverty for yourself. So when it comes to the world of finance, I just want to give you this picture so that it's clear to you as to what needs to be in place to actually build and understand these fundamentals, but also be able to say, okay, what does that mean in how I make decisions? So in the whole spectrum, when you're looking at finance, finance is just a science. It's a science that describes on how we create and how we create money and how we manage money. It's about the instruments that make sure the money moves, because money only get created when it moves from one person to another, through an exchange or through understanding of the risk, but it has to move based on certain circumstances. And those circumstances are created by the market, and irrespective of the nature of the business or the nature of the transaction or the nature of the entity, it doesn't matter. We will have 3 categories. When it comes to finance, it will be public finance, corporate finance, which is business finance, and personal finance. But in all these 3 distinct categories, how the instruments are used and move when it comes to money, it's exactly the same. So therefore, when you're looking at finance at that level, it's understanding that those decisions are influenced by economics, they're influenced by fiscal policies, they're influenced by monetary policies that the government will actually have adopted. And then within finance, you're gonna need to also understand that you will then scale down to now looking at the institution that, or the entity, which will, in this case, we're talking about business. So which means under that corporate finance, it can be personal finance or it can be public finance. But now on the corporate finance, we're looking at the study of money that focuses on decisions relating how you actually finance the asset, which is the investment, but how you actually invest. And the last one is about the return on investment, which is what we call dividends decisions, which is also shortly a return on investment. So when it comes to corporate finance, it's really around those 3 decisions, and each of those decisions is interlinked. So how you're gonna select the financing is gonna be influenced by what type of investment it is. Is it a short-term or long-term? If it's a short-term, we'll talk about working capital and cash flow and different instruments. But when we're talking about long-term, we'll then talk about debt, that is equity, and we'll also talk about long-term. So the matching principle when it comes to financing and investment really goes hand to hand. And then obviously the outcome of that, which is going to be the return on investment. And that return on investment is really influenced about the cost of capital. How much does that cost? And also is influenced by the return in overall in the market, what is currently out there. So because it provides an alternative. So if you decide I'm going to invest in a business, that business must give you a better return on investment than if you had taken your capital or the money to invest in something else where there was a guarantee on capital, but there was also a return that is higher. So those are the things that you're going to need to keep in mind when you talk about corporate finance. So when those decisions are made, those 3 decisions, they then have to be managed on day to day to make sure that the investment that we have is looked after, is being utilized properly, and also making sure that even the financing of that asset, there is payments that are being done, but also there is affordability of the business, but also reducing the risk of that debt actually not being paid, and also managing it. When it comes to return on investment, it's about making sure that the asset is generating the income, and the income that is spent, the money that is spent is far lesser than the money that we have received, so that there will be a net profit, so that there will be a return on the total investment as a whole. So financial management is really about the day-to-day. It's about efficiency and effectiveness on how the finance function is run to achieve the goals, which are the goals that are set on the corporate finance. And then when you are analyzing the financial management, it really looks at quite a lot of things. So to look at how, as a business, we are planning, how we're executing, how we are reporting, but also how are we generally utilizing the resources that we have. So that will cover all those issues when it comes to financial management. Now, once those activities are run in the organization or in the business, they then get recorded. They get recorded in bookkeeping system, which is a system that the accountants will call double entry, the debit and credit. But those book entries that are recorded, they then get summarized by the accountants. The accountants will then summarize the information according to a specific framework based on the uses of the financial information. So that is how the world of finance actually work, but without not going through too much detail on how the instruments actually get used and managed. Obviously, when it comes to the debt, we'll talk about interest, inflation, and a whole list of things. But within that environment, when it comes to specifically on finance, we are just responding and figuring out the way of maximizing the shareholders' wealth or the shareholders' interest. So when it comes to economic factors that influence the finance as a whole, it's really about access to credit, access to resources, the economic conditions in the local area, at the provincial level, even at the national level when as a South Africa as a whole, but also the role of the neighboring countries. It's also about demand and supply of your services or your products, or including also to your inputs, i.e. your raw materials. When you look at economic factors, you also have to understand it's highly influenced by political stability, micro stability, level of the infrastructure, natural resources that are available, education standard, savings, foreign aid, and barrier to entry or barrier to trade. What is actually happening in that space in your industry, and what is happening in your industry? How does that influence the whole value chain? So those are the factors that you're gonna keep in mind when you're looking at economic factors, on looking at your organization and how you're building it to see how it gets influenced by economic development. The issues that will affect your business economically, that affect your bottom line, will range from your market share, your brand image. Brand image is very much about the positioning, how you have positioned your business, and also your competition, the product life cycle, economic growth, exchange rate, but also the cost of production. All this will influence your profit. And you see, on the cost of production, the economies of scale will actually kick in. And on competition, depending on how you have positioned your brand or your product, you can either be competing with people at the same level, or you could branch out, but going on niche also has its own risk and reward. So you're gonna need to have a clear assessment of that. The product life cycle, that is very important. So you might find that it's the first time you're doing this product or offering this product, but that product life cycle in the market is already at its exit. So irrespective of what you do and how often you do the things that needs to be done, you just need to understand of where your product life cycle is in relation to what you are doing. If you're innovating on it and building up on what is already existing in the market, again, you're gonna need to consider what are the risks associated with that, and what's the cost, but what's the alternative? Because if the client is having the alternative somewhere else at a cheaper rate, they will take that. So just also understand that the role, the consumer, how they respond to you innovating, and you don't end up over capitalizing. Okay, so other additional economic factors that will influence you, direct and indirect, is inflation. Definitely that is direct. Unemployment, that will affect you indirect in other industry, but in other industry it will be direct. interest rate, definitely if you have a debt, but also if you intend to borrow money. And the last one, exchange rates. I think exchange rates, especially in the South African context, it's gonna affect you all the time. Why? Because South African economy is a consumer, is not a producer. When you're a consumer, you will need to understand that the exchange rate that we are trading with, i.e. the American dollar, which is usually the trading currency, it will always be stronger than the rand. But one of the reasons why the rand is always going to be weak is because we are not producing enough. We are not producing enough for us to buy, but also on the areas when we are producing, it's just not economically viable to buy things in South Africa. It's cheaper to buy it externally. So therefore, exchange rate is always going to be a contributor to your cost. And it might be having maybe sometimes when another currency crashes, it might take longer to have an effect. But when American, for example, something is happening in America, it will affect you direct. So, and there's a saying that says, when America sneezes, everyone catches the flu. So I think you just need to keep that in mind. So then when you are in this environment, which decisions you have to make and how those decisions then get interpreted into your business. So your aim in business is to make sure that the decisions you are making are increasing your income and reducing your expenses. And that is what we call financial performance. It's what also the accountants will call comprehensive income. That is what used to be called income statement. Then the next two set of decisions that have to be made is actually assets. We're going to have to make sure that we increase the asset in the business and reduce the debt. And the main purposes of that is so that you can increase your net worth, which is basically the financial position. And that is also used to be called a balance sheet. So basically what I've just explained is exactly this. This side, we have income statement. This side is balance sheet. Your aim is to make sure that the asset produces the income, which is what you earn, and what you earn gets spent, but not so much. The other portion is to pay off the debt. And when you say income less expenditure, you get profit, which is a return on investment. And when you say asset less debt, which is your liability, that will then give you the net worth. That will also give you how we will do valuations. Just remember, this is what we call financial statements. I know what is missing here is cash flow, but cash flow is really a movement between income statement and the balance sheet. And in business, how we measure the success of a business is through its financial statements. Now, as I had explained when we were talking about finance in that cycle, I also then said, we make decisions about this performance on how we will maneuver around things and economic factors and so on. But all of those things, they are trying to help us so that we make better informed decisions on corporate finance, which is what is covered here. So as I had said earlier, corporate finance is about 3 decisions: investing, financing, dividends. And all of that just basically means you're gonna need to invest in an asset, and that asset must be financed either by debt or equity, but that must give us the return on investment, which is basically profits. Corporate finance, when it comes to investing decision, is really about looking at what's the long term, what's the short term, but also then deciding, okay, for long term, as I said earlier, it's capital. budget or capital expenditure. And then when it's short term, it's working capital. And working capital have different layers within it, depending on what you want to actually finance within the working capital. But it also has cash flow management. It also have the managing of cash management. It also relates to managing of the your accounts when it comes to customers, but also managing of suppliers. And within the investment decisions, there's a specific framework. It starts from you being clear, what is your goal? And then figuring out based on the assets that you have, the growth and where you're gonna find the growth, but also where you're gonna get the defensive asset. So the assets that are basically gonna protect you, but also you're gonna need to look at how those assets are actually, the mix has been diversified, but also focusing on making sure that there is some sort of taking advantage of the tax, but making sure you then build up to decide on which specific investments that will give you this type of fixes. When it comes to investing decisions, it's really around the motives, which is basically the goals, the external factors that we've spoken about when it comes to PESTEL, the business confidence on understanding that based on what the environment is influencing the economy. I'm sure you've heard when there is discussion with MUSA and other business organization or association talking about business confidence. You see, business confidence, when it's high, there is a lot of money flooding through. But when the confidence is low, it also means the investors will tend to take investments that are reducing, that are not as exposed to the environment as it will have been. So in then deciding on these factors that we're talking about, the framework. Now, when we are looking within finance, we have to understand that there will be two types of financing your business, either it's debt or equity. In other instances, it can be both, but also the financing structure for that and also the cost of that capital. That would then influence what decisions we make. Just keep in mind that financing decisions are also going to be influenced by internal and external factors. The state of economy, the structure, the money markets, the requirements of the investor, the government policy on that issue, the tax laws, the lending policy in terms of financial institutions. And when you're looking externally, it's the nature of the size and the business. So I think this is swapped around. This is supposed to be saying external and this is supposed to be internal. There is a big typo here. It needs to be swapped around. So when you're looking at internal, we're looking at the actual business itself, the owners, the trend of earnings, the number of years the business, the liquidity position, the working capital requirements, but also the conditions of the debt that are currently within the business. Okay, so the third decision, which is the last one, is about dividends. So dividends, as I said, is about return on investment, is about you getting your money that you have invested in. So the person who gets dividends is the person who has investment. So, and there's different types of dividends. There's advantages and disadvantages in getting money through this, but all of that is influenced by a dividend policy, but also the return earnings. Please keep in mind that in terms of Companies Act, there's specific legislation that a Companies Act or a specific section that requires that business cannot pay dividends if its assets is less than the debt. Two, it doesn't have sufficient cash to be able to pay. So you really also have to meet both liquidity and also solvency requirements. Okay, so what factors that will influence the dividends decisions is a whole lot. The earnings, the policy, the liquidity, the policy of the competitive companies, the past dividends rates, which is what we also call dividends yield, the debt obligation, the ability to borrow, the growth needs. So you can't just say you're going to pay dividends, but whereas the business needs maybe an injection into your business. So you're also going to have to look at the tax implication and also the trade policy, but also the attitude of the investors. How are they actually assessing, or what do they expect to make money from this? So that is important. That will influence on how you then make those decisions. So now, which activities on a day-to-day basis, which financial management activities are we going to make to make sure that we have that return on investment and the investment is being looked after? And the third is that we have sufficient funds to be able to do the things that we need to do to fulfill our investors' requirements as per the shareholders' agreement. So it will be borrowing money, sale of fixed asset, collecting of accounts receivable, that is your customers. Just keep in mind the sale of asset in terms of Companies Act, if it's majority of the asset, it will need the shareholders, the majority shareholder, to sign off on that. So those are the things that as directors, when you are making decisions, you have to make sure it's actually in place. Buying the asset, making the transaction, whether it's credit sales or cash sales, doesn't really matter. All these are decisions and activities that we run when it comes to building up the activities around financial management. But we also just have to keep in mind that this is all governed by a specific principle in finance about return on investment in relation to the risk, time value for money, which just means the 100 Rand you have today is not going to bring you the same value in 5 years' time, 2 years' time, or 1 year because of inflation. The profitability and liquidity, that is correlated, because if the business is profitable but is not being leveraged properly, you're going to run into problem. Cash flow principle, which is making sure that whatever that is coming in is always higher than what's coming out. The diversity principle, which means that you do not put all your eggs in one basket, and hedging, making sure that you are actually leveraging. So that is how you will then understand. So this principle, I'm brushing through them now, but you're gonna need to understand them to make the right decisions this side. Okay. So we spoke about financial management. We spoke about how these decisions are actually made, but these activities needs to then get recorded. They get recorded in an accounting system, which is called bookkeeping. And that accounting is categorized in 4 areas. We have financial accountant, management accountant, tax accountant, and cost accountant. And all this type of accountants, they have different roles. I have included a video here on the top. I will also make sure I have it below here to provide you with a more detailed description on how these 4 types of accountants that you need in your business, irrespective on how big or small your business is. But keep in mind that accounting is governed by this principle, irrespective of which type of accounting you're looking at, which focuses on the assumption, the concept, and the constraint. Again, I'm not going to explain this. I just need you to be aware of it so that when you are dealing with the matters relating to finance, understand these are the things that are either going to make your business or going to break your business. So again, have a look at that video. Now, when it comes to bookkeeping, it's about reading the financial decision, recording the financial, but all of this is the past. When it comes to bookkeeping, you're gonna need to understand how are you processing the data, and where is it managed, where is it filed, how is it getting collected, how safe it is, what system is in place, but how are you categorizing and classifying this information so that it's easier to be able to summarize and report on it through these principles. Because when that has been done, it allows the accountants to be able to then apply these assumptions and concepts and constraints within the recording system so that it makes better for the person who's looking at your business when it comes to how you're going to actually raise money in terms of funding, financing, but also what assets you should be looking at and what is the return on investment. So I also just wanted to bring this to our attention on saying that finance is not accounting and accounting is not finance. Have a look at that description and the different type of it, please, and read it. And if you have any question, just leave me in the comments below. You gotta need to understand that those are not the same thing, but they are interrelated. You have to understand that financial management, it looks at the entity as a whole on how we're doing financially, whereas accounting is more supporting the finance team in making and assisting in decision making. So, and there's a whole lot of jargon within bookkeeping of what exactly it is. But what I just want to explain to you is very simple to understand. It's about us making sure as accountants that the records of the business are properly managed, but it allows us to be able to summarize the information based on different categories as per the framework or the users of financial statements. I think as a role, as an entrepreneur, you shouldn't try to understand bookkeeping. You should rather focus on how much money came in, how much money came out. Can I reconcile how much money came in to what the accountant has actually written? So you will say something like, okay, show me how much, what's the total income you have? Okay, you have 15 million, I have 5. There's a huge difference there. Which invoices you didn't account for. So that is how you should approach it. Only focus on those 4 decisions: income, expenditure, asset, and debt. That's it. Don't worry about the ledgers. Don't worry about double entry. Don't worry about journals. Don't worry about a whole list of things that as accountants we deal with. And I think in all, we also have to understand that if you're gonna be in business, finance is a business language. You cannot delegate it. Even if you do delegate it, you're gonna need to give it to someone that you trust, but when that person talks to you, you have to know what they mean so that you can then make the right decision. Because that person is just advising you. They're not saying anything else other than just advising what's the right decision and what's the wrong decision. But you still have to make that decision yourself. Okay, when it comes to financial concept, really it's about understanding what are the words that we generally use versus what are the business words that get used. And I have not made it complex. I mean, this can really get complex when you throw in the different financial instruments and the whole list of the hedging, the whole list of things related. So I just want to keep it simple for now. Just simply what is debt, things that is owed to you or your business is called liabilities. What is called profit is the return on investment. What is sales is the business world is called revenue, and what is called customers that owe you money, they are called accounts receivables or debtors, and then suppliers are called accounts payables because that is people that we pay. But there's a whole list, guys. The aim is to take these small bites. Maybe if I was you, your challenge would be 5 new words, business words in finance that you can add in your vocabulary, and then you build up on it. I think when you start including what is happening with the crypto markets, or there's a whole list also of different instruments and names and things that are actually coming into the market. So focus on learning basics first, and then build up on your vocabulary. And please leave us questions, and there is no such thing called stupid questions. Ask the questions, send us I've also included the WhatsApp group, which you can join by a link so that you can pose your questions. There's several coaches and mentors in that group. Make sure you do join and leave out your questions. All this basically is allowing you to be able to see that as much as sometimes the world of finance can feel overwhelming, it is possible to learn it, and you're going to have to learn it bit by bit over a period of time and ask questions and attend sessions like this to help you to actually bridge the gap between yourself and your accountant, between yourself and your bank manager. And thank you so much for being here. Give us thumbs up for this session and download the slides. I will make sure you have the slides. And if you need additional support, let us know. Thank you so much. Goodbye.